Welcome to the Financial Quarterback with your host, Jim Lineweaver.
Hi, I'm Jim Lineweaver, your financial quarterback since 1993. In the last year, low interest rates have become the norm as the Fed has used them to combat the economic impact of the coronavirus. This can make it challenging for investments like CDs, your savings accounts, even higher yielding accounts to make enough to outpace inflation. That means that your money is essentially becoming less valuable over time, which gives you less buying power. So today I'm going to talk to you about some strategies that you can use in this low interest rate environment to try and increase your yields and your overall returns. I want to start by talking about bonds since they're really the catalyst behind generating income in most portfolios. On the downside, they will fluctuate with interest rate moves and also have default risk. But they can generate income and serve as a ballast in a portfolio when equity values are volatile. Some people and advisors that aren't familiar with the individual bond market might choose bond mutual funds to diversify a portfolio. However, you have to be careful because when interest rates rise, these types of funds could lose money, not only because of the inverse relationship between interest rates and bonds, but also because funds don't have any set maturity date. One of the things that you can do to alleviate this is to create a bond ladder. So you're investing in bonds that mature at different times or even over certain periods of time. So for example, you can buy individual bonds or even bond laddered ETFs that will mature in 2022, 23, 24, even 25. And as these mature, you can reinvest them at the end of your bond ladder. So in other words, when the 2022 individual bonds or ETF matures, you can go out and buy the 2026 maturity. So keep in mind, though, bonds don't come without risk. You have to make sure that you check on the quality of the bonds you are buying to try and minimize the default risk. If you're worried about inflation, which could easily be here by the end of the year, you can look at Treasury inflation protected securities, often known as TIPS. These are designed to increase and decrease with inflation as measured by the Consumer Price Index. So when they mature, you are paid the adjusted amount or the original principal, whichever is greater. We've talked quite a bit about bonds and other income producing tools, but you can also purchase individual stocks that pay dividends to help generate some income as well. If you don't want to hold individual stocks, there are even ETFs that offer dividends, which can help you meet diversification and allocation goals in your portfolio. These are just a few of the strategies you can use to help prepare your portfolio for this low interest rate environment. The important thing is to meet with a certified financial planner, preferably one who's independent. Oftentimes, large, well-known companies will only offer you a few of these solutions. Look at the many options that are out there, discuss it with an experienced professional, and make the best decision for your financial situation and goals. If you have any questions about your portfolio and how to position it during these low interest rates, we're here to help. Please give us a call. Stay tuned for the Chris Wallace Show coming up next.